The news regarding the opening and subsequent reclosing of the Strait of Hormuz last weekend fully illustrates the immense uncertainty surrounding any negotiations in progress between the US and Iran in the current environment. While the US delegation has arrived in Islamabad to prepare for talks, Trump has also stated that the days of saying nice things are over. Whether these related topics can provide the market with new surprises this week remains the primary focus for investors. On Saturday the 18th, Iran opened fire to repel tankers, leading to the reblockade of the Strait of Hormuz in less than 24 hours. The Iranian military stated that due to the U.S. violating ceasefire commitments by failing to lift the maritime blockade on Iranian ports and vessels, the Strait of Hormuz has been blocked since the evening of the 18th. Iran's supreme leader declared that the Navy is ready to inflict a new painful failure on the enemy. On Sunday, Trump stated that although the U.S. delegation will arrive in Islamabad for negotiations and Iran has seriously violated the ceasefire, a deal can still be reached. Trump noted the U.S. has proposed a very fair and reasonable agreement, adding, "I hope they accept it, because if they don't, the U.S. will destroy every power plant and every bridge in Iran. The days of being nice are over." He also mentioned he is very likely to travel to Islamabad if a deal is finalized. The weekly chart for WTI crude oil recorded another plummeting trend with double-digit losses. Yet prices stabilized near a critical support zone and staged a gap-up rebound at the start of this week. This performance mirrors certain patterns from the previous week. While the overall center of gravity for oil prices is shifting downward, the core driver remains the progression of the geopolitical situation. If a final agreement is reached, oil prices may drop toward $70, though the room for further decline is limited. Should full-scale hostilities resume, prices could break through the 120 high and surge toward historical peaks. If the fighting while negotiating scenario persists, the 100 level will act as a central axis, with a high probability of frequent turnover and two-way volatility. The gold weekly chart has recorded 4 consecutive bullish candles, yet it failed to effectively stabilize above the major short-term pivot point near 4,800. The flag pattern rebound remains fragile overall. Any shift in the fundamental landscape could risk a resumption of the downtrend. Following the significant slump in the first quarter, gold's long-term trend has loosened, suggesting it may no longer be able to reach new record highs, and in this context, the risk of prices returning to previous lows after a rebound remains high. From a technical perspective, there is little change from last week, with the battle for the 4,800 level being crucial. A successful hold could pave the way toward the 5,000 level. Initial downside support is seen near 4,400, and only a break below the recent low of 4,099 would signal the end of the rebound and initiate further declines. The US dollar index fell with a mid-sized bearish candle last week, but found support near the long-term trend line and rebounded toward the close, successfully holding its core position. The level of 98.5 has shifted into resistance after being breached, followed by further resistance near 99.10 and stronger pressure around 100. If the index effectively stabilizes above 100.42, a potential large double bottom structure will emerge, with a theoretical bullish target pointing toward the 104 level. On the daily chart, the target for the small double top is near 97.5. A break below this would signal an accelerated decline and potential new lows. While long-term downward pressure on the dollar persists, true selling pressure on U.S. assets may only occur when the market perceives the end of U.S. hegemony, a shift that might only materialize with the onset of a new phase of conflict, such as a ground war. The S&P 500 surged with a large bullish candle last week and refreshed its all-time high, indicating that the strong stay strong dynamic of U.S. equities remains substantially unchanged. As the final and most crucial bastion of USD assets, the market's tendency to rise easily but fall with difficulty is unlikely to shift before the midterm elections. With the emergence of new highs, the 7,000 level has begun to transition into new support, and bulls will remain firmly in control of the situation as long as this level is not breached. This no-ceiling price action implies that technical indicators are currently struggling to predict a potential reversal peak. Bitcoin's weekly chart showed a pullback from highs as bulls attempted to rally toward the theoretical target of 80,000 but were unsuccessful, leaving a notable upper shadow. The failure to secure a weekly close above the previous rebound high suggests that uncertainty persists, though the risk of a sharp short-term decline remains relatively low. Following over 2 months of low-level consolidation, the direction of the next phase will likely be guided by changes in the news landscape. If prices return to the 80,000 level, there is an opportunity for a correction toward 100,000, though the likelihood of reversing the bear market remains limited. A break below 60,000 would confirm the end of the rebound and trigger a new round of declines.